This chapter is taken from the book Money, Present and Future by Patric Chan. You can learn more at moneypresentandfuture.com today. Enjoy this free chapter.
The 3 buckets of money allocation. Your income should go into 3 buckets. For the context of it, your income is defined by the money you earn. Sometimes you earn money elsewhere, not just your salary. The 3 buckets are I. Savings that are safe all the time but have minimal return. U. Low risk investments that are safe in the long run. K. High risk investments but high returns. Savings that are safe all the time but have minimal return. I'm not a financial planner, and this book is not about financial planning. My definition of this bucket is mostly for emergencies and predictable returns. At the same time, I'm not a big fan of saving to be rich. I believe that to be rich, you must learn how to acquire money rapidly and in mass, but you must have passive and semi-passive incomes to stop getting pressure from work. I don't believe in retiring either. I will still work, but not because of chasing money, like writing this book. It's a form of work, but regardless of whether this book makes money for me, I couldn't be bothered. I enjoy the work of being a creator, creating content, and being a teacher. So as a benchmark, you should have savings that can last you for 6 months without any incoming income. Then continue to build that up to 12 months, etc. The more extended period you can build up your reserve, the happier person you'll be because you won't have financial stress. For me, I would like to have savings for 3 years. Now that you understand the philosophy of it, let's plan out the allocation. Initially, your allocation to savings would be higher than low risk and high risk investments because you're building up your emergency portfolio, remember? Once you hit the 6-month reserve, you can start different allocations. To make sure we're on the same page, the purpose of a reserve is to give you the time to recoup back your earnings if some financial catastrophe happens in your life. The concept of the savings in this bucket is not for you to retire. So the more months of reserve you have, the lesser your stress is going to be for you. But here's the good news. You can still make your savings earn for you. The common place for savings would be fixed deposits by banks. It's 100% safe unless the bank goes bust. And if you're ever afraid that such an incident may happen, use your country's national bank. That's very safe. However, I'll usually not go for fixed deposits because it's usually extremely low return unless you can get a good interest rate. At the same time, if you're young and working with a company, forced savings should also be initiated for you. Of course, different countries have different rules. I believe that in the US, it's called the 401k Employee Savings Plan. In Malaysia, it's called EPF. I can't say for the US because I do not know the interest rates there, but here's my advice. You want to ensure your contributions to your employee saving plan never get interrupted. I did not include it in the savings bucket simply because this kind of fund doesn't allow you to withdraw for emergencies when you need the money immediately. I don't want you to touch this fund because interests are being given out and you're getting the compounding effect. Compounding interest is a concept that refers to the ability of money to grow exponentially over time. It occurs when you earn interest on both your initial investment, principal, and the accumulated interest from previous periods. In simple terms, it means earning interest on top of interest. For example, you invest $1,000 in a savings account with an annual interest rate of 5%. At the end of the first year, you would earn $50 in interest, bringing your total balance to $1,050. In the second year, the 5% interest is calculated on the new balance of $1,050, resulting in an additional $52.50. Over time, as the interest compounds, the snowball effect occurs, and your money grows faster and faster. This compounding effect becomes more pronounced the longer you let your money grow, where the power of compounding lies in time. The earlier you start saving when you start working in a job, the more time your money has to compound and grow. After all, the minimal income from your salary for your retirement plan savings won't make much difference in your lifestyle. But when you can withdraw it, the sum suddenly appears vast. The other financial instrument for savings that are safe all the time, but have minimal return would be bonds. You can easily inquire about bonds from your bank, but basically, this is what bonds investment is. A bond is like a loan you give to a company or government. In return for your money, they promise to pay you interest at regular intervals and give back your original amount after a certain period. It's like lending money to a friend, and in return, they give you a little extra as a thank you over time. And eventually, they'll pay you back the original amount you lent them. Imagine you have a friend named Tim. Tim asks to borrow $100 from you, and in return, he promises to give you $5 every year as a small thank you for the next 5 years. At the end of the 5 years, he'll give back your original $100. In this scenario, you're the bondholder, and Tim is like the company or government issuing the bond. The $5 he gives you annually is the interest, and the $100 he returns at the end is the bond's face value. From here, I'll also split into two types of savings. Type 1, predictable savings. This one would be such as fixed deposits, bonds, employee savings funds, etc., as explained earlier. The interest rate is fixed, thus your return is predictable. Type 2, volatile savings. For this one, my savings goes into investing in company shares that pay out dividends. While the interest return is not fixed, your return could also be higher. A company dividend is a portion of the company's profits that is given to the shareholders. If you own shares in a company, you are one of its owners, and when the company makes money, they might decide to share some of that profit with you. It's like getting a slice of the pie from the profits that the company makes. Imagine you and your friends decide to start a lemonade stand together. You all put in the work, and at the end of the day, you make a profit from selling lemonade. You then decide to divide the profit equally among yourselves. Each friend's share of the profit is like a company's dividend to its shareholders. If the lemonade stand is the company, then you and your friends are the shareholders, and the money you each take home at the end of the day is the dividend. It's your reward for being part of the business and helping it succeed. But instead of putting in your work, you're just an investor by buying the company's share. There are companies that will pay out dividends each year, and some of them have higher returns than Type 1, predictable savings. However, it's considered volatile simply because you could earn lesser or even none if the company did not perform well. Usually, stocks from banks will have dividends. For choosing a company that pays out dividends, the best bet is to choose an industry where it's stable and also recession-proof, so that you can reduce unwanted surprises. Once you've built up your reserve, I'll allocate between 40%, 50% towards the savings that are safe all the time but have minimal return bucket. This means if opportunity prevails in the other two buckets, I can reduce this bucket's portfolio to 40% but nothing less. If you have $10, then $4 needs to be in this bucket to keep you not worried about money. So what's the return I'm looking at? Any savings investment that gives 5% to 10% annual return. Low risk investments that are safe in the long run. For the remaining income that you have, after putting 40% or 50% into the saving bucket, the allocation for this would be 30%, 40%. Here's how it works. Assuming you already have your reserve, be it a 6-month reserve or a 3-year reserve, whichever makes you feel comfortable, and also depending on your age. If this is my portfolio, 50% of my investment will go into the savings, and 40% could go into the low-risk investments that are safe in the long-run bucket. But if you're more adventurous and begin to take higher risks, you can allocate just 30% here, and the rest goes to the high-risk investments but high-return bucket, the third bucket. I can't teach you how to invest because that's not my expertise. As in, I can't direct you to where you should be investing. I'm just able to give you the guidelines. Anyway, For this bucket, I'll consider the stock market. I prefer the US stock market, which is often considered one of the leading stock markets in the world due to several factors that contribute to its prominence. Size and market capitalization. The US stock market is the largest in the world regarding market capitalization. It is home to some of the largest and most valuable companies globally, such as Apple, Microsoft, Amazon, and Alphabet, Google. The size of the US market makes it an attractive destination for investors seeking exposure to companies with significant market presence and potential for growth. In terms of this, the possibility of the company to grow tremendously is also high. Thus, the share price could also go many times fold over time. A classic example would be Amazon, which went public in May 1997 with an initial public offering, IPO, price of $18 per share. The stock price closed its first day of trading at $23.05 per share, a gain of 25%. In 2016, when Amazon's stock price was trading at $900 per share, Cathie Wood, the founder of RK Invest, bought 1 million company shares. As of March 8, 2023, those 1 million shares would be worth over $3 billion. Since then, Amazon's stock price has grown by an incredible amount. Based on March 8, 2023, the stock price is $3,122.44 per share, a gain of over 17,000%. There are a few reasons for Amazon's stock price growth. First, the company has been a dominant force in the e-commerce market as the world's largest online retailer and has continued to grow its market share in recent years. Second, Amazon has diversified its business beyond e-commerce. The company offers many products and services, including cloud computing, digital streaming, and artificial intelligence. This diversification has helped Amazon to reduce its reliance on e-commerce and improve its overall financial performance. Third, Amazon has been investing heavily in growth. The company has spent billions of dollars on new warehouses, data centers, and other infrastructure. This investment has helped Amazon to keep up with demand and expand its reach into new markets. I brought this up with some explanation of the company's background because I want you to understand this. You'll choose the company's share to invest based on research, not by luck or listening to rumors. I'll go for tech companies because I understand this industry better. For instance, I would think Meta would be successful in the future despite all kinds of negative points about the company. It may not be now, but a 10-year plan because I foresee that the growth of virtual reality and augmented reality will reach the mass by then and be adopted. If Meta is going to be the leading company in that space, why wouldn't the company's share be worth a lot then? So here is some of my advice for this bucket. If you invest in a company's share, choose the industry you're familiar with and understand the company's product. Always go for blue chip companies. This bucket is not meant for high risk. With a blue chip company, it's likely to survive any abnormality, also known as black swan events. Choose the company for the future. Whether the company's product will always be in demand in the future or it's involved in the future's technology product. You're investing for the long term, expecting 5 years or more. You're not supposed to manage this bucket. Meaning, in general, if the share price drops drastically, you're not supposed to let it go, but buy more for averaging it out with the expectation that over the years, it'll bounce back and continue to grow because of what the company's doing. It'll also help you take some time to read about fundamental investing. You're investing based on the company's performance and its future to grow, not based on the current sentiment or any stock charts. Last but not least, for this second bucket, you're investing in the company's stocks for capital gain, not for dividends. Because company stocks that have dividends usually don't have much capital gain and vice versa. Companies with high capital gains do not perform well with dividends at all. Most of the time there are zero dividends because the earnings of the company are usually reinvested into the company to continue expanding. So what is capital gain? It is the increase in the value of your investment. If you buy a stock at one price and later sell it for a higher price, the difference in the amount is your capital gain. Basically, it's the profit you make from selling your stock for more than you bought it for. Imagine you buy a toy car for $10. Over time, this toy becomes popular and rare. A year later, someone offers you $20 for that same toy car. If you decide to sell it, you made a profit of $10. This extra money you earn is like the capital gain in stock investment. Just as you sold your toy car for more than you bought it, you sell your stock for more than its original price. For instance, with the Amazon stock's track record I shared earlier, the capital gain was very impressive. High risk investments, but high return. The third bucket will be higher risk, but the return on investment, ROI, could be higher than the former. At the same time, you should never gamble. Keep in mind that you're investing, not gambling, with your hard-earned income. Gambling would mean you're investing without proper research or a plan. For this bucket, I suggest investing in cryptos. Of course, there's a massive debate about this in the investment world. Warren Buffett, the legendary investor and CEO of Berkshire Hathaway, has been a vocal critic of cryptocurrencies like Bitcoin. Buffett's main objection to cryptocurrencies is that they do not produce anything of value. He compares them to tulip bulbs, once seen as a valuable investment but ultimately worthless. Buffett believes that cryptocurrencies are a speculative bubble that is bound to burst. Here are some quotes from Warren Buffett about cryptocurrencies. "I don't own any cryptocurrency and I never will. I don't think they're a productive asset. They don't produce anything." 2018. "If you told me you own all the Bitcoin in the world and you offered it to me for $25, I wouldn't take it because what would I do with it? I'd have to sell it back to you one way or another. It isn't going to do anything." 2020. "Cryptocurrencies will come to a bad ending." 2018. "I don't think Bitcoin is going to last." 2019. "Cryptocurrencies are rat poison squared." 2019. But at the same time, Michael J. Saylor, the founder of MicroStrategy, which is likely to own the most Bitcoins in the world, supports crypto heavily. There are several reasons why Saylor is enthusiastic about crypto. Store of value. Saylor sees cryptocurrencies, especially Bitcoin, as a potential store of value. He believes that the limited supply of Bitcoin, only 21 million coins, will ever exist, and its decentralized nature makes it an attractive alternative to traditional fiat currencies, which can be subject to inflation and central bank policies. Digital gold. Saylor often refers to Bitcoin as digital gold. He sees it as a digital asset with many qualities traditionally associated with gold, such as scarcity, durability, and divisibility. Long-term investment. Saylor has taken a long-term investment approach with Bitcoin. He sees it as a multi-decade investment opportunity and has stated that MicroStrategy's Bitcoin purchases are part of a strategy to protect the company's treasury assets from the potential devaluation of fiat currencies. So, who's right? I would suggest you only take their opinions as information to analyze for yourself. Because the truth is, it's probably highly biased. If you have a lot of Bitcoins instead of USD, this goes without saying that you would want Bitcoin to be highly valuable so that you'll not lose all of your assets. If you have billions of USD and no Bitcoins, I'm sure you wouldn't like Bitcoins. The fact is that the risk is there. This is why I don't encourage you to have more than 20% in this bucket. Although you can push up to 30% depending on how well your other buckets are and your skill in acquiring income. For this bucket, please make sure you clearly understand these remarks. We're investing. Like investing in stocks, you're buying crypto to hold for the future as an asset for investment. Only buy blue chip cryptos for investment. As of releasing this book, the blue chips are Bitcoin and Ethereum. Bitcoin is the gold standard, while Ethereum is beyond a currency because it's a technology, a product widely used in Web3 today. But because they are high risk with the possibility of plummeting insanely, you should consider mitigating your risk. Don't invest ignorantly. You see, due to the fact that they can plummet that way, it also means they can skyrocket like crazy. And for that matter, there's a window of opportunity to reduce your risks even further. This is the model that I'll use selling to get cryptos at a discount. I'm going to give you a theoretical illustration to teach what I mean. The numbers below are not real, just for demonstration. Assuming I bought one ETH at $2,000. If it goes up to $4,000, I'll sell 0.5 ETH of it to earn back my original investment. And with that, I'm no longer having any risk regardless of what's the price later on. But I get to keep 0.5 ETH as my investment. I would rather have less crypto in my portfolio with zero risk than worry I may lose money. But to wait for it to reach $4,000 may not be so fast. Thus, even if it goes up to $3,000 instead of $4,000, I would consider getting back some of my investment. Maybe I'll sell 0.5 ETH to earn back $1,500. With that done, I'll still have 0.5 ETH. However, the 0.5 ETH in my portfolio would only cost me $500 to own. Although it's a theory, the craziest part is that it is possible that the ETH price can go up 2x. You may need to monitor, but it doesn't need to be taking up your active time since the spike won't happen in a single day. There are apps that you can install into your smartphone, and when it hits a certain threshold you've set, it'll automatically alert you. The goal here is always to minimize risk. The game of financial independence and debt-free is a marathon, and it's okay if you're earning less each time, because it's the accumulation of it that will lead you to your financial independence. Never get into trading. Whether it's stock or crypto, please don't get into trading because trading is not investing. I get it. It's easy to make money by trading. When you make the money, you'll feel you can repeat this. You'll think that if you can make $100 daily, you can do this every day and make $3,000 monthly with minimal effort. The reason why I know you'll think this way is because I've done that and lost money. In my opinion, if your goal is to make money, there are other ways that are less risky, such as starting an online business. The entire book, Money, Present and Future, is to help you craft a life without money worries and hopefully to be debt-free. Let me explain to you why trading can wipe you off entirely. Remember, what you've learned about money is emotional. You see, the market, regardless of stock or crypto, is inherently volatile, with prices fluctuating based on various factors such as economic conditions, company performance, geopolitical events, and investor sentiment. With sudden downturns or unexpected events can lead to significant losses. Emotions can heavily influence trading decisions, leading to impulsive and irrational behavior. Fear and panic during market downturns may prompt you to sell at a loss, locking in the losses and potentially missing out on future recoveries to build your portfolio. One significant loss could take away all of your wins. Achieving financial freedom and debt-free typically requires a long-term perspective and a focus on wealth preservation and growth. Trading in a speculative manner can undermine these goals. By risking your income, you expose yourself to significant losses that may not be recoverable in time for other investments or to build up the portfolio. Besides, let me ask you a frank question. Have you ever met anyone who achieves financial freedom by trading? I haven't, but I've met many with proper investments. Even if they don't achieve financial freedom, they're happy because they don't have to worry about losing.